Good afternoon, everybody, and thank you for joining us. Today is October the 13th. It is Wednesday, and thank you for joining us for our third quarter macro presentation. We're excited to present to you today. On this call, we also have Andrew, who will be speaking, Andrew Hall, and our Director of Fixed Income, Tom Russell. I am Ben Nye. We'll kind of just jump in right now for the disclosure. This is information that we believe to be accurate, cannot guarantee its accuracy. You can see the remainder of the disclosure here, and we will be publishing these slides later if you need to check out this disclosure in more detail. We're going to start off actually with a poll, and we're going to see how this works. So just getting a collective thought on the economy. While you answer that, kind of discuss what's happened over the past 3 months. And we've seen increasing polarization in views. And that's not just a political statement. We've actually observed two different realities, especially in the economy, in politics, and it's difficult sometimes to get resolution. And the thing that a lot of humans want is we want resolution to things. We want resolution in our music. We want to go to a satisfying conclusion in films. And we want resolution and an answer when we say, what is the economy going to do? And as these results come in right now, we're talking about 54%, 50% people are optimistic, and 50% of people are nervous or fearful. Actually, about half of you, a little less than half now, think that the S&P 500 will end 2021 lower than it is today. And it's about split 50-50 as to whether or not the S&P 500 will be up in 2022. And so there is that intellectual tension. We obviously didn't know the results of these polls before we did this macro presentation or came up with these slides, but it's very interesting to see just the degree to which there is that difference in terms of how people are feeling about things. With 22 people responding, we now think that 45% of people responding think that the S&P 500 will end 2021 higher than it is today, and 55% think that it will end lower. So I'm going to end this poll and share the results with everybody so they can see it. So hopefully you can see that on your screen. And we'll just kind of jump right into it. So stop sharing here. Today we're first going to be talking about what happened in the third quarter. And I think as we'll explore how the third quarter progressed, it really progressed differently than what we were thinking in June and July. In June, people were excited. COVID was on the decline. We were all looking forward to a July 4th where we could see friends and family again. And then as things progressed into July and August, things definitely slowed down. And that continued into September. And we'll talk about what that meant for stocks and bonds. And the second, really the meat of the presentation, we're going to be talking about the bullish argument, or we're going to be talking about the bearish argument as well. And that goes for markets, that goes for the economy. And then in the final section, we'll kind of wrap it all up and tell you where we think things are most likely to fall. So moving on to that first section then. In terms of the economy, this quote by Winston Churchill is very apropos. If you put two economists in a room, you get two opinions, unless one of them is Lord Keynes, in which you get three opinions. And I don't think economics has really changed all that much in the last 90 years since Winston Churchill said this. And it is extremely apropos to where we are now. People say, well, things could go up, but on the other hand, they could go down, which really doesn't help. So we're going to talk a little bit about what did happen and then give you the bull and the bear argument for what is likely to happen. So first of all, as we all know by this point, job growth did slow in the third quarter. You can see that in this chart. It began to slow again over the Christmas time at the end of last year and into January. And then it picked up substantially in the spring, giving people optimism for the summer and hope that jobs would come back in the fall. But unfortunately, we actually saw the opposite. What's interesting is if you think about December and January of this past year, you did have another wave of COVID that emerged at that time. And you did also have another wave of COVID that emerged in July, August, and September. And so for as much as we would like to pretend that COVID is no longer a factor, unfortunately, it still does have an impact on the economy. And we can also see that in terms of layoffs. We saw that really good progress. You want a low number on this metric. And you saw really good progress in the spring months in May and even into June. But in July and August, we saw a leveling off in terms of the number of people who were getting laid off. And that's not good. The numbers on this chart are very small, but if you look closely, you can see that we're about 325,000 to 350,000 new layoffs every week. And that's pretty high. That's high even for a normal time period. And a normal time period, just in order to recoup those from normal attrition, you're talking about 250,000 in terms of initial jobless claims that you need to be. So especially in a recovery, you don't really want to be seeing 325 to 350,000 every week. So jobs have definitely stalled out a little bit, and that's measured by the government. As measured by private business, we're also seeing a little bit of a stall out in terms of employment. If you look at the ISM services employment, again, we had really good numbers as we went into the spring, but now that's begun to taper off. That's the green line, falling a little bit more below 55. And manufacturing employment has also been fairly weak. Any number above 50 indicates expansion. Any number below 50 indicates contraction. And so you see the ISM manufacturing employment flirting with that 50 number. It's pretty hard to grow an economy when your manufacturing employment isn't growing at all. In fact, in August, it may have actually declined. And at the same time, we have this job growth slowing. We actually have job openings that are surging. So this is not an issue of the jobs not being available. We have about 10.5 million jobs available right now as we speak. And this is really, in our view, a probability of matching. There's a high level of incongruity between the jobs and wages offered and the jobs and wages prospective employees expect. It could be temporary. You think about a lot of these job openings are in businesses that are reopening, which tend to be travel and entertainment space. And in that space, wages tend to be a little bit lower. And for those people, who have been receiving $1,000 checks from Uncle Sam, $15 an hour just doesn't sound all that much. And so what's happening is that you're actually having a lot of wage growth occur, but primarily in those jobs that require less education and those jobs which typically over-index to younger people. So the green line on the left-hand chart is high school. So wage growth by people with a high school education. The purple line is people with a bachelor's degree. So you see, for the first time in a long time, people with high school education are receiving outsized wage growth versus people who are more highly educated. Similarly, you see younger people, age 16 to 24, who are really seeing their wage growth increase dramatically, and people who may be a little bit older are not seeing the same types of wage growth. So it does fit that a lot of the wage growth is happening in areas that are trying to reopen and may have been more impacted by COVID than some other areas. And this is leading into some inflation. So while at the same time we're seeing softening employment numbers, we actually saw in the third quarter higher inflation. So inflation was really strong. If you think about those lumber prices in April and May, inflation was very strong, but it's still strong today. For context, prices are rising at any point above 50 on this chart. And so we're right now between 75 and 85, depending on which indicator you look at. So prices are rising very rapidly. And although they've come off just a little bit from the spring, they're still going up and going up in a fast manner. You really want to have a little bit of inflation, but by a little bit, we're talking inflation in that 50 to 60 range, not inflation in the 75 to 85 range. So there is a concern that inflation is coming, inflation is here, and it's coming at the same time that employment growth is slowing. You're seeing this in the nationally reported numbers. Consumer price inflation is picking up. Even if you normalize out for the base effects from last year, that green line, you're still seeing inflation close to 3%. The Federal Reserve's sticky price measure puts inflation at 2.5%, which is still above their long-term average target of 2%. So we are seeing inflation continue to be an issue. Businesses are seeing rising costs. These are the costs that compared to last year, so on average over 3% higher. And as a result, they are planning for higher inflation going forward. So they plan for 3% inflation. This change in inflation expectations is extremely notable and could mean we do have higher inflation over the next period. I would note that a lot of this does deal with supply chain bottlenecks, and we'll talk a little bit about that later. But the end result is in the third quarter, we saw significantly higher inflation and we saw a significant tapering in job growth. You put that all together, and that does not speak well for economic growth. The green line on this chart measures the Atlanta Fed's estimate of the US economy's GDP. So what this chart shows, and you can broadly ignore the blue line, this is just economist expectations. The green line takes into consideration all the data that is coming out and is purely a data-driven model that the Atlanta Fed puts out that is expected to approximate where GDP ultimately comes down. And you can see that at the end of July, the data was showing that we were going to grow at 6%. Today, that number is 1.3%. And it really tailed off in August and September. And so the story that we're telling is the third quarter did not progress as expected. And inflation was higher than expected, and employment was lower than expected. And that's not the entire, that's what happened. So why did it happen is the question. Well, I think a lot of the reason we can point to is this healthcare impact. So if you look at the gold line on this chart, you can see you had a massive decline in that gold line. The gold line signifies the healthcare situation in the United States, or alternatively, the COVID situation. And you can see that big spike down in March and April last year, and then you can see the big spike down over the winter, and then you can see the leveling off in the summer months. And then I would also draw your attention to the purple line. The purple line signifies demand. And if you follow that, you can see a big decline initially in March and April of last year, followed by a pretty significant ramp back up, a small decline over the winter, and now we're sitting at over 100% of pre-pandemic levels in terms of demand. I'd contrast that with the red line, which declined, but not as much last spring, and then never really got going. It tried to get going early this year. You can see the red line and the purple line were actually fairly well linked. But in the last 3 or 4 months, the red line really came off and the purple line continued to go higher. And this happens as the healthcare data is deteriorating. And so what this shows is that while this most recent wave of COVID didn't have as much impact on demand, in fact, demand's actually higher today than it was before the pandemic, it did have a significant impact on production. And so when we're talking about supply chain issues and things like that, you can really kind of distill it down to the difference and divergence in the purple line and the red line. And it seems very correlated to the leveling off in terms of that gold line, which is the healthcare side of the equation. So that's the bad news. The good news is that we may be turning the corner. So if you look at the Taiwan Semiconductor monthly sales trend, this is a good proxy for semiconductor production. You saw, again, that big ramp up in the springtime, the fall off in the summer, and that very interesting data point in September, which shows that we may be accelerating again. As a proxy for demand, we can look at Costco. So Costco, the orange line compares end demand relative to pre-pandemic levels, and that's been relatively steady. The 1-year line has moved around a lot, but that's because it's comparing over last year, which at times was extremely volatile. So you see some volatility in that green line, but that orange line is very steady, and that bodes well for end demand. Andrew, talk a little bit about the survey data that's been coming out.
Absolutely. Thank you, Ben. Great outline there to kind of frame this up. So one thing that we look at pretty closely is business sentiment and how people feel about their outlook as business operators. So this is survey data from the National Federation of Independent Businesses. It's the largest group or association of independent businesses in the U.S. They have offices at every capital. It's a bit of a lobbying group as well. And you can see on the left side of your screen the Optimism Index. And if you look at that in September, you see a reading of 99.1. The big thing I would encourage you guys to realize is that this is really a combination of 10 different survey indicators and different questions that these business operators are asked. And it's not graded the way a term paper would be. So a score of 99 is not flirting with an A+ necessarily, because if you look back further, you can see numbers that are, pushing that 110 level even. If you go back to 2018, we were sitting at 108.8 in August. And so you can see optimism remains much better than it was, say, in April of last year when the reading came in under 91. But 99.1 shows a little bit of a downgrade from what we saw even in August. Even a month ago, we were at 100.1. So businesses remain kind of in that middle ground if you look at kind of recent history, the last 4 or 5 years, in terms of what they expect. And in a way, that's very similar to the polling data that we asked you guys in terms of your feel for the economy and your outlook for the market. What's interesting is this question to the right of your screen. They ask business operators, what is the single most important problem that you are facing? And I would draw your attention to quality of labor. Quality of labor is the single biggest concern that business owners are facing right now. It came in at a score of 28. And for context, that is the highest captured score ever for this category. So people are more worried about the quality of labor than they ever have been before. And I think that's really interesting because when we think about the unemployment situation as well as job openings, it's interesting because I think a lot of people are focusing on some of these front page headlines that you might see in terms of the cost of labor. Labor inflation, it's going up. Minimum wages are going from $12 at some businesses to $16 or $20 or $25. That is a concern, but that's not the biggest concern. The biggest concern is quality of labor. That's more concerning to them than the tax situation, which is sure to change. It's more concerning to them than the inflation picture, more concerning than governmental regulation. All of these things are concerns, but not to the extent that the quality of labor is. So we touched early this year in our first macro of the year about really kind of this labor mismatch. And we think that's continuing to be a factor. And you can see that as business owners continue to worry about who are the right employees. We also conducted, if the NFIB is the largest association of small businesses, the Narwhal Capital survey is the smallest association, small businesses. But we reached out to some of our clients who own businesses to ask them questions in terms of their view on the Atlanta economy and their optimism as it relates to their own company. And you can see as it relates to the local economy at large, there's really varied responses ranging from 2 all the way up to 9. If there's one consistent trend here, it's that we apparently have a lot of clients that are very confident in their businesses. And we're certainly hoping that they're right, because most people are more optimistic about their own company as those readings are coming in kind of in that 5 to 10 range, with the majority of the responses coming in kind of at 7, 8, 9. But we're continuing to see similar concerns from people that are operating businesses. 89% are worried, at least to some extent, about cost inflation. We've talked about that. We've talked about supply and increased demand and the challenges tied there too. We'll continue to talk about the supply chain mismatches, but that is a concern. Some comments we've got from the construction industry: the availability and price increase in roofing material is creating major issues across the board for us right now. Somebody working in metal says, my company wants to thrive and make money, but because we have to spend so much on steel to stay ahead of increases, this year has been difficult to grow our cash position. So that's somebody having to consistently take on inventory at a high rate so as to, in the future, have steel at an appropriate price. We also see we're looking to upgrade in certain positions now that we have reached the desired headcount. That kind of lends itself to what we saw from the NFIB in the sense that we're really looking for the right people. It's not just a numbers game in terms of employees. We need the right people. Someone else in education services, I found this very interesting, says that market-specific trends in the law school admissions and tutoring business suggest that the total number of law school applications may go down. That's a real departure from what we've seen over the last 18 months. For the last 18 months in a difficult job market, there were a lot of people going back to grad school, pursuing different education so as to make a career change. We're starting to see that subside, which probably is a read-through on more and more people actually going into the workforce.
And we're seeing these issues that small businesses are facing really have an impact even in the markets. So the Russell 2000 is a great gauge of smaller cap stocks, and the S&P 500 is large cap stocks. So your big companies, your Microsofts of the world, et cetera. And what we saw was, when things were really heating up in the springtime and even into the early summer, the green line, which is the small cap index, the Russell 2000, was outperforming the brown line, which is the large caps. But in the third quarter, the brown line, the large caps, really outperformed the small companies. And part of it is the small companies don't have as much control over their supply chains and things like that as the large companies do. And if we really zoom in on the third quarter, we can see this in more detail. Large caps outperformed to the tune of 5%. Small caps, it was a tough quarter for small companies that were digesting these labor issues, that were digesting these periodic COVID-related shutdowns, that didn't have as much redundancy in their workforce, that was digesting some of these cost pressures and these freight pressures. So we definitely saw large cap outperformance continue into the third quarter. And interest rates continue to support the actual growth slowing narrative in Q3 as well. Interest rates tend to be a good barometer of what's going on in the economy. When interest rates go down, the economy might be slowing a little bit. And that's what we saw. Again, in early in Q3, we began to see interest rates decline and stay at low levels. What's interesting is at the end of Q3 and actually continuing here into early October, we have seen interest rates go up. And so that may be a sign that things may be turning in terms of economic growth and where the economy goes from here. So the bottom line for Q3, it was negatively impacted by a number of factors. You had the return of COVID in July, August, and September. You had shutdowns in Asia, which we're going to talk a lot more about here in a few minutes. You had normalizations in sales trends. Think that Costco chart that we showed. And then you also had difficult comparison periods as you weren't comping over a period of very weak times like we were in the spring, when everyone was posting 100% growth because their businesses were shut down in 2020. If we look at moving on to the bull and bear indicators for the economy, the biggest bull cases that we can make are, number one, the concept of COVID reaching a peak. Number two, the notion of an inventory replenishment cycle that restocks our depleted car lots and store shelves. Number three, a capital equipment cycle that enhances employee productivity, allows companies to do more with less. Household savings, which continue to be a big story, and corporate defaults that are historically low. So we're going to start off by talking a little bit about COVID reaching a peak. And some of these initial slides may seem negative, but think about where we're going from here. So first of all, let's talk a little bit about the supply chain issues. Supply chains are a mess right now. Nike talked about their supply chains, their freight times doubling from 40 days to move product from Asia to North America to now 80 days. Kohl's was cut from buy to underperform at Bank of America at the end of September. The stock was down about 12% on that news because Bank of America said, we just want to get out ahead of these supply chain issues. And Micron is has a finished goods inventory that is the lowest level since 2013. That's pretty remarkable given how much larger the market is for semiconductors today than it was back in 2013. You've seen companies like Bed Bath & Beyond. Bed Bath & Beyond was down 15%. Some of this was traffic going down in August, as we've seen in some other data. But another piece of it was just these supply chain challenges. They had steeper cost inflation escalating month by month beyond the significant increases that they had already anticipated. This stock was down 25% in a single day when the company reported earnings at the end of September. And we're seeing that really the result of these massive shutdowns related to COVID. So it's easy to be relatively closeted off from it here in the United States, but Asia was really shut down in the third quarter. And I think this stems a lot of the supply chain issues that we saw. So here's a chart of the China Manufacturing Index. Anything above is 50 is growth, anything below 50 is contraction. And you can see that beginning in July and into September, we really began to decline significantly. And in fact, in September, China was in a manufacturing recession. We saw the same thing in Vietnam, except for the entire quarter, Vietnam was in a manufacturing recession. And that really fell off in July, August, and September. And we talked about Nike earlier. This is where the vast majority of Nike's shoe factories are. It's hard to grow your shoe sales if the places that manufacture your shoes is shut down for 10 of the 12 weeks in the quarter. And ultimately, if you put this all together, this is what we get. U.S. demand is higher. We talked, remember that red line and the purple line from earlier. U.S. demand is significantly higher, but production is down. And if you look at the chart on the right-hand side of this slide, what you can see is that production actually did a very good job of snapping back at the end of last year and staying very close to new orders. But beginning in the springtime and really extending significantly in the summer, production really fell off. And you had that gap emerge between new orders and production. And because these economies were shut down, you couldn't deliver on these orders, and it's really creating some significant headaches in the supply chain. It's helping to create that inflation that we saw, and it's creating out of stocks and lower sales. Delivery times, again, when things turn back on, they turn back on quickly. Back over the springtime, you saw that blue line here at the right-hand side of the chart really go down rapidly. But in the last few months, lead times have lengthened significantly because you have that gap between very strong demand and relatively low levels of production. And just one more chart that shows you the degree of lockdowns that are taking place in Asia. US, we were at about less than 25 on that lockdown stringency index. Malaysia was 80, China was in the 70s, Vietnam was in the 70s, India was in the 70s. These are a huge production engine for the global economy, and they're pretty much shut down, especially when you talk about the large cities. So again, when we're talking about supply chain, we got to start where the places with the production. And the production wasn't happening because these places were locked down because COVID was a lot bigger deal there than was reported about in Western media. Andrew, you want to talk a little bit more about what's going on with COVID now?
Yeah, absolutely. Thank you, Ben. So we're going to look at a couple of these manufacturing nations as we start here looking at kind of what we mean by COVID cases rolling over. So we'll start with Malaysia. Malaysia does a lot of light manufacturing, things like rubber, all kinds of products coming out of Malaysia. I'm sure everyone here has something with a tag that says made in Malaysia in it. And you can really see, as we think about the third quarter period, you can see these cases really start to ramp up kind of right at the beginning of July. So right as Q2 wrapped up, COVID cases started to really climb and kind of spike in the mid to latter part of the quarter and then start to decline. So we're starting to see progress there. And these are very, very high numbers that we're seeing there. Malaysia was dealing with COVID cases at a much higher rate than they had the year before. Vietnam, we mentioned this earlier in terms of footwear, big hub for manufacturing footwear as well as small electronics. Vietnam, you can see, again, almost the exact same pattern that we saw in Malaysia, where cases really start to build in July and continue through August and into September before finally getting to a place where they're declining. So the hope here is that we will continue to see a trend similar to what we've seen in the United States, especially in 2020, which is after cases peak, so to speak, people get more comfortable going back to work, people get more comfortable being out in the world, things start to open up a little bit more. And if you think about how stringent things were in countries like Malaysia or Vietnam, then I don't think it's a stretch to say that we are going to see more output on the supply chain from those countries. Even in the US, we started to see this come down quite a bit. It does seem like there's a little bit of a regional nature to COVID cases. We talk about this a lot on our morning market briefings. But again, similar pattern. We start ramping up in July and we continue to go higher through August and into September, and then we start to decline. So cases really across the board, both on the production side and on the consumption side, we're starting to see a favorable trend with COVID. Now, we're not going to sit here and say COVID is absolutely done, though other people may do so, and we'll share some comments from some folks that think that here in a moment. But we're certainly getting optimistic trends on COVID globally, and that should bring relief to the supply chain. Additionally, as we continue to talk, we've talked a lot about vaccines on these market overviews, these commentaries, but we're also starting to get a little bit of traction on the antiviral side. You know, Merck has a drug that could come out now and essentially for relatively healthy people that may face hospitalization due to demographic risk, they've got a drug that will roughly reduce the risk of hospitalization or death by about 50%. So things like this, I think, are going to help us prevent these huge spikes from being something that happens every single year and really shuts down large portions of the global economy. The world is starting to reopen yet again. This might sound like a broken record if you were on our call in the third quarter of 2020, but you can see some headlines here. Malaysia aims to unshackle economy as vaccinations near 90%. New Zealand to end zero COVID-19 strategy. Vietnam ending their lockdown in Ho Chi Minh City. We're starting to see these really crucial locations reopen. And from Jamie Dimon, the CEO of JP Morgan, this is from a couple weeks ago, or actually fresh comment, excuse me. He said, I should never do this, but I'll make a forecast. This will not be an issue at year end. The worst is behind us. He goes on to say, keep in mind, consumers are buying stuff. They're spending 20% more than they were spending pre-COVID. And companies are in great shape. They can continue to spend at these levels for a long time. And I think his comments, although very concrete and definitive, there's a lot of merit to those. I think one of the headlines that we're not hearing enough about is the fact that much of this inflation that we're seeing is a byproduct of increased demand. That's a good thing. We're going to talk more about consumers and businesses, their balance sheets, all of that later in the presentation. But keep in mind that a lot of the challenges we are facing with pricing right now are simply a byproduct of the fact that people want more stuff. And from an economic level, that's usually a good thing, not a bad thing. You know, we could have no inflation whatsoever right now if demand was decreasing the same way that supply was. But that's not the case. Demand remains strong. It remains elevated.
Yeah, and I think that really speaks well to what we're seeing in need of inventory replenishment. You know, when we don't have that production and we have high demand, we've really depleted a lot of inventory. And so what a lot of bulls would talk to is not only do we need to catch up to demand, but we actually need to replenish a lot of that inventory that we went through in Q3. So here's a big picture idea of inventory. Inventory is at extraordinarily low levels. This is measured by the ISM Manufacturing Index, down at 30. U.S. auto inventory is down to 136,000. You know, back in 2001, we were over 1 million units in inventory. Volkswagen says right now we're in that 30 to 40 days supply on dealer lots. They're managing with it, but that compares to in the past, you're talking 60, 70 days of dealer inventory on lots. They said maybe we're not going to go back to 60 or 70 days, but we got to get back to that 40 to 50 day mark. What's positive about this chart is you can kind of dissect it in a number of different ways, but the big idea here is that inventory wants to be replenished. You see that replenishment spike on that left-hand side as we hit Q1 and Q2 of this year. And I think that will happen again because inventory needs to be replenished, but we just can't replenish it at the present time. And so you saw that line go back down. And when we talked about that Atlanta Fed chart of that GDP beginning to decline as those estimates came in lower than expected, here's what it actually means. You're also seeing a drawdown in inventory. So inventory was supposed to contribute 3.7 percentage points to GDP, but that has been brought down significantly to 2.5%. And so what happens when you see something like this in terms of inventory depletion is that not only do you have to catch up to demand, not only do you have to hit those 1.2 extra percentage points next quarter, but you also have to make up for the inventory depletion you had in this quarter. So you could talk about it being a 2.4 percentage point swing, and I don't think that I would disagree with that. Importantly, we see the low inventories. The question is, are people actually going to replenish those inventories? And if you actually listen to what these companies are saying, they are going to replenish them. CarMax says inventory is lower than where we want to be. It's probably about 30% off what they would target normally. And people are really trying to get this inventory. In fact, some people are shipping stuff by air when they would normally ship it by sea or by train because they need to get product in faster. And so they are intent on actually replenishing this inventory. The NFIB survey, small businesses also think the inventory is too low. This is an all-time high in low inventory. So inventory needs to be replenished. And importantly, they're planning to build inventory. That blue line's about as high as it's ever been. And it was also high about this time last year, and what followed was a good inventory replenishment cycle to end the year and into early 2021. And so I think we could see a similar thing again this time. The capital equipment bull case, I think, is probably one of the weaker bull cases to make. The idea here is that because it's tougher and tougher to get employees in, businesses are going to be looking at adding capital equipment, adding efficiency, adding tools for productivity in order to get more out of the employees that they do have. And I think the intuition makes sense. The problem is capital equipment's a function of optimism, and we need to get optimism higher before we can have that capital equipment cycle. And to get optimism higher, we need to resolve the supply chain. So I'm going to caveat what I'm about to say with those comments. So capacity utilization levels are high. So this is, again, is the thinking behind the bull case that we need to hit a higher level of capital equipment purchase. Capacity utilization is really high, whether you're talking semiconductors in a specific industry or on the left-hand side of the chart, just overall capital equipment expenditures in general. But small businesses are slow to spend. They are not optimistic. And when you're not optimistic, you don't want to invest and spend a lot of money on something that is only going to work if your end markets grow. And when you're concerned about just getting your next shipment of steel in or your next shipment of lumber, you're not going to invest in new equipment. And so I think that's what's holding capital equipment back. So capital equipment's probably a little bit of a longer term story. But one thing that we did want to touch on was we are seeing a bit of a shift from Asia and South America into North America. So North America capital spending expectations did notch down a little bit this last quarter to 8.8%. But if you compare China and North America here, China capital equipment, a lot of that's going down relative to North America, where a lot of more people have an intention of increasing their capital allocation to North America.
we're going to touch on next is really the American consumer and what the household is looking. I think as people, we have a tendency to think of just really bad events and try to view potential economic challenges through the lens of previous experience far too often. So we've had a lot of folks, kind of looking for, hey, what's the next Lehman Brothers collapse? What's going to trigger the next global financial crisis, in which we're looking at a really stunted economy for a long time. And I think a lot of those signs really are missing from the present economy. And part of the reason that's missing is we're looking at very, very strong balance sheets at the personal level here in the United States. And as Tom will touch on in a few minutes, also at the corporate level. So one of the things we keep an eye on is consumer debt. So when you think about problems and you think about stress that may hit and really hurt, you tend to think of a trigger event that can be negative, and then that event becomes significantly amplified by the levels of debt. So if you look at this next slide here, we have historically low levels of consumer debt. So this is household debt service payments as a percentage of personal income. So it's essentially the amount of money you're spending to service debt relative to your income. And you can see this chart goes way back into the early 1980s, and we're about as low as we have ever been, and by a pretty wide margin. So as we move in from 20 into 21 and into the back half of 2021, we're continuing to see consumers look favorable. If anything, this actually can create some headwinds to certain parts of the economy, like the financial sector or banks that really need to be loaning money in order to make money. But we're seeing very, very strong balance sheets on the personal side. The next slide will also show you credit card delinquencies. We are once again really at all-time lows here, under 1% as it relates to credit card delinquencies. So the American consumer, on the average, has really weathered the storm very well. In an earlier macro presentation, we talked about the percentage of household income that was actually saved in 2020 being at an all-time high. When you combine that with income going up in certain areas, credit card delinquencies being very, very low, debt service payments being quite low relative to income, it's easy to understand why we're pretty confident that the demand is going to remain elevated here in the United States. So I'll pass it to Tom. He's going to talk about corporate balance sheets and give us a little bit of a better picture on that as well.
Yeah, so one of the positive things about being in such a low interest rate environment is a lot of companies, along with individuals, they've been able to really take advantage of the low interest rates and get into a better financial position. And that's really what we're seeing across the corporate landscape. So this is a chart that shows you the spread between what would be a high yield security and a treasury. And what you're seeing here is that we're at historic lows, which means you're getting compensated the least amount of money for taking credit risk, which is to say, investing in companies that may not be the cleanest in terms of balance sheets. So you're getting the least amount of money for going into what would normally be pretty deep waters in terms of credit. And while there's a good argument to be made that the reason for that is people reaching for yield, as levels of yield have gone down across all bonds, people are now reaching into these lower credit areas to borrow money or to invest. We actually think the positive, the actual driver here is the fact that the credit is actually much better than it appears. Last year we had a ton of defaults, things like JCPenney's or Brooks Brothers, all these different companies. Joseph Bank went bankrupt, but what happened was a lot of these companies took that and they got a lot cleaner. And as a result, there's actually quite a bit of value, we believe, even at these lower yields in the high yield market, in terms of looking in these single B and double B areas in order to maximize yield and find good opportunities. Because as we've become better credit quality across all corporate bonds, what's happened is we've actually pushed out duration, which means that the interest rate sensitivity of your investment grade bonds is going to be much, much higher, which means if we go into a cycle where we do have tightening, where we do have rates rising, your propensity for losing money is going to be much higher in investment grade bonds that are very long versus some of these lower credit quality bonds that may actually be misrated, that have very, very short duration and therefore short interest rate risk. And if the credit story is good, if you can really dig in on it and say, hey, this is actually a company that maybe should be rated single A or triple B as opposed to single B or double B, then you can actually get better protection in a rising rate environment as well as better yield. So this chart is the default rates since 2011. You can see here, we did have a tick up in 2020. It was the highest in quite some time, really back to the financial crisis. But so far this year, we've seen very, very, very low levels of default. And that is a clear indicator that companies are not going bankrupt. And in fact, they're in very good shape. And so this shows you the blue line is going to be leveraged loans, which are a lot of companies that are either too small or don't have the credit quality to access regular capital markets. And then the purple line is going to be high yield bonds, which are going to be the ones we talked about, which are sort of that C, B, and double B level bonds that are available in the natural credit market. One thing to note too, along with this chart, is that Fitch, who's one of the major rating agencies, put out a note in June revising their default rates for 2020 and through 2022 down to 8 to 10% for both leveraged loans and high yield, which is way lower than in 2008, 2010, coming out of the previous recession, where it was between 15% on leveraged loans and 22% on high yield. So they're basically saying, if you're doing your credit quality research correctly, your odds of having a default are very, very low, historically speaking, despite the fact that things do seem particularly gloomy right now. So this is a chart that's going to show you what we call issuers of concern, which is essentially when the major rating agencies come out and say, we're keeping an eye on this company. We have a potential default here. We're concerned about their credit quality, and they be kind of circling the drain, if you will, and moving towards default. And you can see clearly that, again, we're ticking way down in relation to, the last few quarters. It looked extremely high, obviously, in, Q1, Q2 of 2020, and we've ticked down to the lowest levels we've seen since the beginning of the pandemic. And that's something to definitely take into note as well. The number of companies that are potentially going to default has decreased. And a lot of what we would call those zombie companies that have been hanging on for a long time really got shocked by COVID and they went bankrupt, and now those are off the table. And so the remaining, high yield space is made up of a lot of companies that were downgraded, perhaps prematurely, and could potentially be rising angels. So the number of really imperiled companies has decreased significantly. And then this is a chart of debt to EBITDA levels really over the last 20 years or so. And you can see that the level of indebtedness has decreased significantly as well. And the debt to asset levels steady at 25% versus an average of about 38%. And so you can see that despite the fact there's been lots of issuance, a lot of these companies are issuing debt at very, very low levels, especially in comparison to the earnings that they're seeing. And a lot of that new issuance has been basically dog-eared for buybacks, which is, they can borrow money at historically low levels. They can use that money to make investments. They can use that money to buy back their own stock. And so in terms of the balance sheets for the average company, we're looking at very low levels. So, if the average consumer is in a good spot, the average company is a good spot. Those landmark events like the Lehman Brothers or a company going bankrupt unexpectedly due to some small move in the market is extremely unlikely in our opinion. And if anything, it's we're at a safer level than we have been in quite some time.
Yeah, and it's definitely feeding into share repurchases for sure. The purple line on this chart shows where share repurchases are right now. And we are at all-time highs in the second quarter for share buybacks. What's even more notable is if you look at the chart on the right-hand side, and that's what the repurchase authorizations have been, and this just goes back through May 7th, an all-time record high in terms of repurchase authorizations. So already what you're seeing is if we're already buying back stock at the highest levels in history, we're about to buy back levels at an even faster rate because of all these repurchase authorizations that have taken place. And, maybe that rings alarm bells, and that's fair. But when you have companies and good corporate with balance sheets like they are, like Tom just mentioned, you can afford to buy back stock. And part of that is they just need something to do with all this cash. They're also investing in mergers and acquisitions. We saw one of the highest Q3s in terms of M&A. In fact, arguably the highest ever in terms of mergers and acquisitions activity for a third quarter. And this just shows the degree to which corporations are flush with cash and need to deploy it. And they're a little bit hesitant to deploy it on capital equipment because that entails taking a significant risk and investing and incurring expenses. So they will instead buy bolt-on mergers and acquisitions, do financial transactions by taking advantage of low interest rates, and buying back their own stock to increase their earnings per share. So overall, the bull case, again, like we said, COVID impact appears to be declining. We're on the leading edge of that decline right now as these economies in Asia rebound. Number two, have that inventory replenishment story. And it seems like people are intent on replenishing inventory as soon as they can get the supply chains back on. Number three, you have that capital spending, which I think is probably a longer term story. Household balance sheets are very strong, corporate balance sheets are very strong, and they're going to be buying back stock. So that's the bull case as we see it today. The bear case is that this is as good as it's going to get from a potential GDP standpoint. You're going to continue to see these supply chain disruptions, and DC policy will turn into a headwind. So beginning with, is this as good as it gets? So the argument that it's as good as it gets is that we're at 100% of normal sales levels. So the thinking is demand can't go any higher. Now, Jamie Dimon would disagree with that. He thinks that normal has been reset to a higher level, and you could argue that's the case with household balance sheets and corporate balance sheets where they are. But the fact of the matter is we're back up to normal sales levels. But profit margins are still tight, and they're probably going to tighten further because of the cost inflation pressures that are going to happen over the next period of about 6 to 12 months. And this constrains earnings, because if sales don't go up, but profit margins tighten, that means your earnings are going to go down. At the same time, you have this big employment gap where you have all these job openings and you're not getting any more jobs. And again, we explained that there is a view that this is COVID related in terms of people not coming back to work, and people need to get used to making their $15 an hour, and there needs to be a market reset. That's how capitalism works. But there is a line of thinking that these jobs just aren't going to come back. And to the extent that they come back, they will pressure corporate profits. So the line on the left, the chart on the left, shows that revenue has recently picked up to very good levels. As we know, demand is high, but employment has fallen off. So essentially what this is saying is that companies are doing more with less, but that can't continue ad infinitum. So if you look at the right-hand side, this is what they expect to happen. So what businesses expect to happen is that sales are going to normalize and employment is going to pick up. That's broadly good for the economy, but it does mean earnings are going to be under pressure, because again, if your sales start to slow, but your employment and your costs increase, that means that's going to pressure your earnings. So again, the question is, why are we seeing this leveling off in jobs? Is it because of COVID, or is it because there's a permanent lack of workers in the United States? And I would postulate that it's because of COVID. So if you look at the chart on the right, this goes back for 18 months. The Census Bureau has done this survey every 2 weeks. Who does not want to be employed? That's stayed relatively consistent between 5 million and 6 million people. On the chart on the left, you've seen a big spike in terms of people who actually have COVID or are caring for someone with COVID. And that's the reason they're not working. So this is the reason they're not working or collecting unemployment benefits. And that increased from 2 million to almost 5 million in July and August. So when we talk about the job growth slowing in July and August and September, I would postulate that COVID is a primary determinant of that, because you're fighting a 2.5 million person headwind in terms of job growth, because people are either sick with COVID or caring for someone with COVID. Again, we looked at that caseload data before. It seems like that's coming off the top, which could allow us to accelerate here into the end of the year. But the bear case is that those people who don't want to be employed, they're never coming back to the workforce. We also have the issue of supply chain disruptions lasting longer. It looks like right now, people think that supply chains should begin to normalize beginning in the spring and lasting into the end of 2022. You talk to FedEx, they're hoping for an improvement early in 2022. That was a very hopeful, by the way. If you listen to that conference call, extremely hopeful, lack of certainty there. Nike is a little bit more positive. They expect that things will be a little bit more back to normal in December and into the spring. Micron, that semiconductor company, toward the second quarter of next year. But Volkswagen, they don't think it'll be normal until the second half of 2022. So it's going to take quite some time to get back there. And on top of that, the final piece of the bear case is policy in Washington, D.C. And Tom will talk a little bit about this.
Thanks, Ben. I can tell you that a number of people on this call have had conversations with about the negative impact of everything going on in Washington, everything going on with the Fed, and how it could be a potential drag. And I think there's definitely a clear argument that should there be a bear case, that there's going to be a lot of headlines and a lot of action coming out of DC that could potentially impact markets going forward. The big one is going to be obviously fiscal policy and monetary policy. We do know that there are potential tax changes coming, and the sooner those come into play, the more likely we are to have a bit of a drag on the economy. In addition to that, it's going to be very difficult for companies to have fair comps over previous earnings, especially if we get into a scenario where the Fed is starting to shrink their balance sheet. We've got tapering on the table. We've got a potential rate hike on the table, and all this easy money goes away. And that definitely has a potential to be a drag, particularly if it's timed improperly. If we start, really seeing the bear case develop, and we're also tapering and raising rates, we could definitely be in a position where we've made a policy error and we're hiking into a recession, which could be a serious problem. So here you can see, this is obviously the topic of discussion most on the fixed income side of the business, which is the fact that, even today we got the Fed meeting notes where they're talking about reducing the asset purchases beginning either November or December by $15 billion a month. And this is a forecast for all of the central banks. So that includes the ECB, Bank of Japan, Bank of England. All this easy money that's been pumped into the system really over the last, call it a year and a half, 2 years, is about to go away. And that's going to make it very difficult for, just this easy money sloshing around companies to continue to, finance their business by very, very low debt. And so that's going to make it more difficult going forward. Now, that doesn't mean to say that rates are going to spike exponentially and it's going to become very, very expensive. We'll probably stay in a relatively low interest rate environment for some time. But the easy money tap is definitely being turned off, and it's being turned off worldwide. And so there could be some negative externalities coming into play as that happens.
So wrapping it up, the bull case, again, we talked COVID, inventory replenishment, household balance sheets, capital, corporate balance sheets. And then we also talked on the bearish side, what is normal? Are we already at this normal sales level? Are supply chain disruptions going to continue? It looks like they'll continue for a good another 6 to 9 months. And then on top of that, you have the fiscal and monetary policy that's likely to tighten. So where does that leave us? Whatever we heard last is kind of what the proverb says. The one who states his case first seems right until the other comes and examines him. So let me set the stage really quickly. We only have a few slides left, but talk a little bit about where the market sentiment is. And because I think this is ultimately unlocks what the key is. Bank of America bull bear indicator is very neutral right now. 0 means everyone is scared. 10 means everyone is greedy. As Warren Buffett says, buy when people are fearful, sell when they're greedy. Right now, there's a whole lot of nothing, which basically means if the economy kind of trundles along as it is, we're about priced for it. And if the economy unlocks and opens up and really accelerates to the upside and we get good job growth, then we need sentiment to catch up and the markets will probably go up as well. You also have the downside case, if these supply chain issues not only stay bad but get worse, the market probably fall a bit. But what's interesting is that market sentiment has moderated, and we're at one of the more bearish levels that we've been in the entire year, and we just continue to get more and more negative. At least market participants as a whole. Deutsche Bank did a survey here in this bottom left-hand chart saying that 71% of professional investors expect a market correction of more than 5% in the last 2.5 months this year. And this is after the market's already fallen over the last month. So people are quite negative on where the markets are going. And I think that actually sets the stage, which could be set up for a strong finish if the economy does open up well. So you have these cross currents, as you always do in macroeconomics and markets, but I do think there are favorable conditions as the supply chain opens up, assuming it does. You have tighter conditions emerging in 2022, as Tom pointed out, with fiscal policy and monetary policy. You also have the midterm election volatility. Midterms tend to be a little bit more of a volatile time period. Think back to 2018. And you also have the normalizing top line growth and digestion of cost pressures that we talked about and potential earnings impact thereof. Longer term, I do think that the underlying demographic trends, young population, very favorable population, low levels of debt, and productivity improvements should be positive. So that's kind of the big overarching picture. But encourage you to kind of look at this slide in terms of getting your bearings and managing those cross currents. So the big takeaway, in Q3, the economy slowed down. There's no getting around that. The question is, why did it slow down? And we postulate and propose that it's likely heavily due to COVID-19 emergence again. The bull case is predicated on international markets reopening and to a lesser extent the United States market reopening. The demand climate, as we noted, is strong. The US, we're talking about an economy, a demand economy that's over 10% higher than it was pre-pandemic. The bear case assumes that we've already met the potential GDP. We're not going to get more people back to work, and the supply chain issues are going to continue. Put that in context with an equity market sentiment that's not stretched and low personal and corporate debt, weakening investor sentiment. I don't think there's the case to be made for a bubble. You could make the case for a correction. You can make the case that we go higher, but I don't think you can make the case for a bubble, at least as bubbles have historically played out. So that's where we stand on the economy. That's where we stand on markets. I'll let Andrew take it home with an update on Narwhal.
Excellent. Thank you, Ben. Thank you, Tom, as always. Quick update on Narwhal. As a reminder, we put this in the chat earlier. We do have market commentary that we bring every morning at 8:30. If you have questions about how to find that or you can't figure out the chat, give us a call, shoot us an email, give us a text, whatever it may be. Secondly, continue to check out our blog. Luke Burton and John Grayson have done a great job really kind of pushing content out there. It's varied in terms of what we're writing about, but I think it's pretty useful. We've rolled out an Employee of the Quarter program. We tried to be as corporate as possible with it. John Grayson, an account executive here, took home the award for Q1. Natalie Rogers, who joined our team this year, took it home for Q2. So great work by them. We'll keep you posted on Q3. It's going to be a highly contested battle, I am sure. And on the personal side, Emma Grayson is now a person. She married John Grayson. So Emma's been around, but now she is officially part of the Narwhal extended family. And Luke Burton got married as well just 2 weeks ago. So very recent. Congratulations to those guys. We do have a couple questions, and I'll kind of open the first one up to you, Ben, as we kind of jump in here. With regards to inflation, transitory versus persistent. And the question is, isn't most inflation supply side if we accept wage growth as stagnant? That points to transitory inflation as seen in lower lumber prices versus a year ago. Ben, what's your view kind of on the inflation situation? And obviously transitory is a little bit of a broad word, but how would you view that?
So interesting on the transitory question. I do think that, we're probably, inflation is measuring price changes. I think inflation measures price levels. I think that we're not going back down. I think that transitory is measuring price changes. I think that there is some normalization potential because I don't think you're going to be shocked. The rate of change is going to slow down from the shock that you saw in terms of the reopening. So again, I mean, I think that you're going to continue to see these levels of inflation probably for some time. Now, what's defined as transitory? I think that's a term that's perhaps been overused a little bit, perhaps by us too. But I don't really expect to see inflation really decline down to that 2% level for probably a year. But I do think we will see some amelioration in terms of those inflation readings. I think that, we'll probably trend down from this 5 to 6% level that we're currently seeing in terms of consumer price inflation to probably more that 2 to 3% level. And as we get closer to 2, it's going to be harder and harder to get back down close to 2. But I think that that's kind of where we see it going. And then in terms of wage growth, I do think that, the stagnation point is notable. People are seeing wage growth, but they're not really gaining a ton of more purchasing power because their costs of goods are going up too. So I do think that's an interesting socioeconomic question.
Yeah, and I think one thing we kind of keep an eye on from time to time, we did not include it here, is we track median usual weekly real earnings. So it's a little bit of a different data of wage growth. And we've seen a little bit of a decline there, but it's a decline really from a peak that, oddly enough, the peak was in Q2 2020. So on an inflation adjusted basis, we're actually higher than we were at the beginning of 2020. And so although we've seen that peak and come down a little bit, it's pretty significant. And this is a category where we really didn't have on this measure, on that median usual weekly real earnings, which is both people that are paid hourly, people that get tipped out after working at a restaurant, people that make salary, whatever it may be, on an inflation adjusted basis. Really from 2009 through 2019, there was no growth in that. And so we've seen, although we've seen a dip over the last 2 quarters as it relates to the impact of inflation, we're still, a good bit higher than we were at the beginning of 2020 and higher than 2019. And it, kind of on a broader, if you looked at this as an annual chart, we'd actually kind of be in the early innings of actually seeing growth there. So just kind of another measure to think about. We can email that out to anybody that's interested. With that, we will wrap it up. We appreciate the questions. If you have other questions that you'd like us to talk about, the morning call is a great place for that. So we're happy to jump in on that kind of stuff. And we'll just turn it over to disclosure and we'll wrap it up here.
I'm taking my time to write down this line, just to let you know how I feel. A beautiful day going my way, think I have a license to steal. Thinking of you, the things that you do, guess I just don't understand. No need to ask why.